Hi, welcome to today's video and thanks for joining me. Today we're going to be talking about this subject, corporately owned life insurance. This is a withdrawal strategy for business owners on how to take your money out of your corporation without paying any income tax. Now, if you're not a business owner, watch this video anyway because this is identical strategy for individuals or households to use life insurance. It's the same way. The only difference is who's paying for it and who owns it. In this case, the corporation owns the insurance, but the strategy is almost identical, right? So you should, if you're curious about this strategy, pay attention to this. Corporate life insurance. Now, okay, let's back up a little bit. Again, if you're not a small business owner, this strategy works for you. It's just the mechanics is a little bit different because it's in a corporation. Nonetheless, the strategy works the same. You're a business owner and you've got, maybe you've got a corporation, a holding company, your operating company. Maybe you've got some mixed assets like real estate, rental properties. Maybe you own the building that your business is in, so you've got some equity there. You got some cash in the business. You got some money in different investments that are just growing and getting taxed in a very uncomfortable way. As you know, the tax rate for money held inside of your corporation is a very punishing 53% tax rate, and so your question is always to me when I do this video in the other previous videos was, David, how does this work? Explain this to me. So I'm going to explain it briefly, but what I'm really going to be doing is just show you the quick 30,000 foot level and then sort of the benefits of what's going on. I'm going to lead you through some of the tables that you've seen me do in the planning software so you can see yourself in this example. Okay, so let's set this up. Here we have this family. And you can see here on the left-hand side, I'm going to walk you through left to right. This is their software, and this is sort of their balance sheet that we put into their software. They want to have $120,000 after-tax income right away when they start, and that's going to go up with inflation, plus the additional expenses like travel, replacing cars, renovations around the house, helping their kids out, so that you see in that first top line, $120,000 plus $86,000. So we've got over $200,000 of expenses that they're going to have. And now, many of you have made this comment saying, you know, can you do videos where the numbers aren't so big? And so in this particular case, this is an incorporated business owner. And so the numbers are going to be big, okay? Sometimes I'm going to do videos where they're not business owners and they're just individual families and the numbers are a little bit smaller. Nonetheless, this couple have money and they want to spend it and enjoy their life. They worked hard to get this money into their business, and so they're asking me, how do we get this money out of our company without paying any income tax? Again, no names here. This is all information that's been changed slightly, so we're protecting privacy of these individuals. Now, you can see here the things that we do inside of planning the government benefits, CPP, and old age security. We've pushed that off to age 70 to try to create a window where we can do some more tax efficient withdrawals. But you notice there's an old age security clawback. No matter what we do with this couple, they're going to have an old age security clawback. Why? Look to the left of that column, you see their incomes. They have distributions coming from two other corporations, and on the over to the right, you see corporation. The corporation is worth $2.5 million. So there's money coming out of that corporation as well. So there's a lot of money flowing. They have rental properties and so on. So there's a lot of money coming to their hands personally that they cannot stop. That's the way they set up their businesses in the beginning. That's the way they set up some of those investment properties. And so they're faced with that kind of income stream. You might see that in your own examples of owning real estate personally. Having corporate did really well with your business, but you've got this income stream coming in from your rental properties. Kind of tough. You can't turn it off. You're not going to tell your tenants to not pay because the tax is too high for you. So this is a dilemma that you're faced with when you're having this kind of assets. You can see the corporation has $2.5 million worth of assets inside of it, taking out about $143,000 a year throughout their life, basically. Now, this is a really great example because it shows where a business owner focused on growing their assets in their company and not personally. So they treated themselves like a corporation and said, we're going to grow this corporation, grow the corporate assets, and we're not going to treat ourselves like we're an employee, even though they're an employee right within the company. But employees pay themselves salaries and they invest in RSPs. And as a business owner, most often that's not the way you should be investing your money. You should be keeping your money in your corporation and using your corporation to grow your assets. In this case, that's exactly what they did. Look at their financial assets. Only $400,000 personally, $93,000 between the two of them in RSPs, and the rest are in non-registered TFSA. So they see their business as their retirement strategy. So what does that mean as an advisor who is doing planning for them is they've got a succession strategy they got to get through, and they got to get through an exit strategy, getting out of that business, getting the money out of that business in a tax-free or a tax-efficient manner. Two simultaneous things, right? Because there's the succession, and I hope that goes well and how that works out. And then there's the, okay, son or daughter, now that you've got this company and it's in your hands, it's time for us to take the money out, and how that mechanism is working. So that's all happening inside of this plan. And so you can see here a lot of moving parts. I hope you see yourself in your own business, the dilemma that you've got. And this is exactly how we help people like yourself to get the money out of your corporation. I'm going to show you the benefit here in a second. So let's just show you, remember I was telling you, if you have personally, you don't have a business, I'm going to show you real fast this strategy. I'm not going to go into all the mechanics, just really fast how this stuff works, okay? Personal structure, if you don't have a small business, there you are. You're either a high income earner, you've got a large non-registered asset, maybe you sold some properties, downsized your house, maybe you're a widower and you've got all this non-registered money. What do you do with the money that you're not going to spend in your lifetime? Because there's a certain amount of money that you're going to spend, right? You are who you are. It's unlikely you're going to change who you are in retirement. So you've got all this money you're likely not going to spend. You're just going to get taxed on it. So what do? We open up a whole life insurance or participating life insurance. You deposit that cash from your non-registered account, not from your RSPs, from your non-registered account, into life insurance. The life insurance gets a dividend, so you're actually getting this tax-free dividend coming into your life insurance. Don't pay any income tax on it. Then you're going to take that cash and you're going to collateralize it. You're going to go to a bank. You're going to say, I'd like to take this cash value and I'd like to borrow against it in order to use that as a loan. And what happens when you have a loan? Same thing as if you did a mortgage on a rental property and you took money out, put it in your pocket, right? That equity, and your tenants are paying it off. That money that comes through a loan is non-taxable. Same thing going on here. And so that's your non-taxable income. So that's a personal setup. Corporate structure. Look, watch how this is pretty much the same thing. You may or may not have a holding company. I see that all the time when I talk to business owners. They only have the operating company, that's at OpCo. And you've got your active assets in your company. I'm not going to get into all that. I've done this in the other videos, but there you are as the owner. You're going to have another corporation where you've got the life insurance set up, and you're going to pay from your operating company into the new corporation and deposit money into the insurance. Now from here on in, same thing, right? It's just different structure, who owns it. You're going to collateralize the cash value that you have in your whole life insurance. That money is going to come to you as the shareholder on a tax-free basis. No different than the personal structure. The mechanics are slightly different, but that's how you get money out of your corporation. The question is, how much do you put in? How much do you take out? You don't have to take a loan. You can leave the money in there and let it be a storage of capital. So let's say you didn't want to do the withdrawals. You just wanted to be able to elevate your estate value through the life insurance. That's going to happen too. So you can just simply get the money from your corporation that's in a mutual fund, an ETF, stocks, bonds, segregated funds. You could just systematically deposit that into life insurance 1 year over the next, and it takes a few years to do that. And then that money that's inside of the life insurance is now growing tax-free, and you're not paying any income tax on that. So you're actually year over year beginning to lower your income tax in your corporation, which is a great thing. If ever you want to tap into that cash, it's available. You can take the money out if you want on a tax-free basis, just like this. Okay, so let's look at is this beneficial? Okay, of course it's beneficial. Otherwise, we wouldn't be talking about a strategy that just doesn't work for you, right? Life insurance multiplies money. That's all I want you to think about life insurance. There's a big benefit here. You're going to, because it's life insurance and it has a death benefit, you're going to elevate your estate value. Look at the bottom of the page. This is on the personal assets. So you know this example is about a small business owner. So there's the company and there's you as the individual. And I'm showing you both, right? Whenever we do any kind of planning strategies, we look at it. How does it affect you and how does it affect your company, right? Income, taxation, estate value, everything. So you can see here the estate value is higher. You see the negative 633. That's comparing no insurance to with insurance. So the no insurance has 633,000 less than if you had insurance. So we've elevated the estate value in this particular case by $633,000. Now, again, this is on money that they weren't going to spend in their lifetime. So like multiple things are happening here. We're saving money on the deposits going into the insurance because there's less money in the corporation to be taxed. So year over year taxation drops. There's no more taxation on all that money because the money is now kept inside the life insurance. So that's growing on a tax-free basis. Awesome. It's available for you to tap into. 90% of that cash value is available anytime you like. And through the death benefit, it elevates it by $633,000. Okay. So it's a pretty important tool to use. Now let's look at it from the corporation. Increase CDA, capital dividend account. Are you following along with me? I know I'm going through a lot of detail and I'm going through it at a pretty good pace, but you can pause and rewind this as much as you like. Let me know if anything that I'm saying, if it's confusing, let me know, put it in your comments, but I'm interested as always to read your comments. Okay, so the capital dividend account is a notional account for corporations, incorporated businesses, by the way, that allows you to flow through all of whatever your notional amount is, so it carries a balance on a tax-free basis to you out of your company, right? So, for instance, when you have life insurance owned by a corporation, the death benefit gets deposited into the capital dividend account. So you can see here the capital dividend account with insurance is 2.3 million. Without it, it's only 1.3 million. So we've increased the amount of money that this business owner can flow out of their company by almost $1 million. So if they have, which they do, other assets other than cash, they'll be able to sell those and flow those out of their companies on a tax-free basis. So not just from a point of view of saving tax year over year and accumulating cash value, but also this ability to flow more money out of your company on a tax-free basis. So this strategy is hitting a bunch of other benefits that you never even considered. If you go up to the top there, you see it right in the middle, it says insurance CSV, cash surrender value. So you know with insurance there's almost 1.2 million, and then not having any insurance, there's no money coming to this company. So all that money is flowing into the company and then out through the capital dividend account. So there's no other tool that does this, meaning flowing money out of a corporation better than whole life insurance. Okay, so I have a question for you, and we're done. Trying to get it under 20 minutes. How much money will you be losing to taxation at your passing? So it's a question, more of a curiosity of you saying, I don't really know. And that's one of the things you really should consider learning about and finding out. We do that by getting a retirement plan done. That's what this whole thing is about. You just saw me going through those tables. Doing a retirement plan, seeing how much money you've got in your estate that's going to be taxed, how much you're going to have to pay in taxation, and is there something you can do about that before you're passing? So you want to know that number because that's cash going to Canada Revenue, and we can help you with that. Thanks for tuning in. I appreciate you being with me again in this video, and I look forward to seeing you in the next video. Thanks, and be well.